Welcome to the deep dive. Today, we're doing a deep dive into mergers and acquisitions for small and mid-sized businesses. Now, this was actually requested specifically by John from San Jose, California.
Oh, right.
Yeah, he started his own business about 4 years back and is looking to understand growth strategies, beyond just beating things up organically.
Makes sense. That's a common point business owners reach.
Exactly. And just for context, this is Season 2, Episode 19 of The Deep Dive. We're calling this season Small Business Blueprint, Bookkeeping, Licenses, Taxes, and more. So this fits right in.
Perfect.
And for today's deep dive, we've had an incredible resource guiding us. The material we're really digging into comes from a super comprehensive guide written by Katie St. Ors.
Ah, yes.
She's a certified financial planner, a tax strategist, and actually the producer of this very deep dive conversation you're listening to right now.
Oh, fantastic resource to have guiding the discussion.
Totally. Okay, so let's unpack this. When we hear mergers and acquisitions, M&A, right? Our minds, they often jump to those huge corporate giants. You know the ones.
Headline grabbers, yeah.
Yeah.
Billion-dollar deals.
Exactly. Multi-billion-dollar deals dominating the news. But the truth is, M&A is, it's fundamental to the small business landscape, too, and maybe even more fascinating in some ways at this scale.
That's a really crucial distinction to make right up front, because while people use mergers, acquisitions, almost interchangeably in everyday talk, they are actually distinct types of transactions.
Okay, how so?
Well, a true merger typically involves two companies, usually similar in size, coming together to form a completely new combined entity. Think T-Mobile and Sprint back in 2020.
Right, I remember that. Two big players becoming one new thing.
Precisely. They consolidate, create something entirely new, often driven by wanting to maybe boost their industry standing or conquer new markets together. It needs a lot of approval boards, shareholders, regulators sometimes. It's like a new corporate birth, essentially.
So not just one swallowing the other, but a genuine fusion, a combination.
Exactly. An acquisition, on the other hand, that's when one company buys another one outright. Or maybe just buys its intellectual property, its patents or brand, or maybe just a controlling share of the stock.
Okay.
In an acquisition, the target company's name, its legal structure, they generally either cease to exist or get absorbed under the acquiring company's umbrella. And, for the deals we're focusing on today, transactions under $15 million, the term M&A almost always refers to these acquisitions.
Okay. So for the smaller guys, it's mostly buying and selling, not merging.
Pretty much. True mergers, where you have two comparable smaller businesses trying to create a totally new entity, they're far less common. Why? Well, they typically involve just a disproportionate amount of legal hassle, integration complexity, things that smaller organizations, frankly, often lack the resources, the money, the dedicated teams to handle easily.
The legal fees alone must be daunting.
Exactly. Prohibitive sometimes. Not to mention the operational headache of truly blending two distinct small companies, each with its own culture, into something brand new. So yeah, for the small and mid-sized business segment, the focus is almost always on one entity absorbing another. It just streamlines the legal side, the structural changes. It aligns better with the practical realities of how smaller businesses actually grow.
That makes perfect sense. Okay, so given it's mostly acquisitions for smaller businesses, it still sounds incredibly complex, a huge undertaking. Why is M&A considered such a potent growth strategy for them? What makes it worth navigating all that inherent complexity?
Trade in your boring job for a brilliant career using Adobe Creative Cloud. Start learning now with the free trial link in the description.
It is complex, no doubt, but it's also incredibly powerful. And the reason is it represents what we call an inorganic growth pathway.
Inorganic growth, meaning?
Meaning, simply put, instead of building everything yourself, new products, new services, expanding into new areas from scratch, you're essentially buying it, often fully formed.
Okay. Buying growth instead of building it brick by brick.
Precisely. And this approach, it can be significantly faster, potentially less risky in some ways, and maybe surprisingly, sometimes even less expensive than trying to grow organically.
Really? Less expensive? How so?
Well, think about organic growth, developing new products from the ground up, slowly adding production lines, gradually testing new geographic markets. All of that demands huge amounts of time, capital, internal resources, trial and error. M&A lets you leapfrog a lot of that.
Right.
Through an acquisition, a small business can dramatically increase its economic value, gain much greater market power almost overnight, and potentially achieve a higher combined market valuation than if they just stayed separate. Imagine, gaining 5 years worth of market share or product development in a single transaction.
Yeah.
That's powerful.
So it's about hyperspeed, getting there faster, but also maybe sidestepping some of those really risky early-stage development hurdles?
Precisely. That's a key part of it.
Ah.
M&A offers this vital strategic lever for small businesses to compete effectively, especially in markets that are changing fast or where maybe consolidation is already happening among bigger players. The motivations behind it are pretty diverse too.
Like what?
It could be about grabbing a bigger slice
Yeah.
of the pie, right? Significantly increasing market share, maybe by buying out a competitor. Or it could be about cutting costs, achieving immediate economies of scale, or gaining instant access to totally new markets, new customer bases, things that would take years to build organically. It's also a direct route to boosting profitability through new synergies. We'll talk more about those. Diversifying the business operations to reduce risk. And critically, acquiring new technologies or very specific specialized skills.
Ah, the tech and talent angle.
Yes. For many small businesses, they might have limited internal R&D budgets or just not have the time for that slow, methodical market entry. For them, this accelerated growth through M&A isn't just like a nice option. It's often a strategic imperative for long-term survival, for staying competitive. It lets them jump ahead years in development, establish a stronger position quickly. That can be the difference between thriving and just treading water.
Okay, here's where it gets really interesting for me and maybe a bit counterintuitive. My gut feeling would be a $5 million deal. That's got to be way simpler than a $500 million one, right? Less money, fewer moving parts, simpler.
Seems logical.
But the material we're looking at suggests that's often just not the case. In fact, it says transactions under $15 million can be just as intricate, if not more so. Why? What's going on there? What makes these smaller deals so deceptively complex?
Yeah, this is what we sometimes call the paradox of complexity in the lower middle market.
Right.
That generally covers deals from, say, $5 million up to maybe $50 million, but our focus today is squarely under $15 million. And you're right, intuitively you think smaller scale equals less complexity, but that's rarely how it plays out on the ground.
Okay, so why the paradox?
Well, several big factors. One is just the unique characteristics of these deals themselves. You're often dealing with first-time sellers, people who might be deeply, deeply emotionally attached to their business. I mean, it's often their life's work, right? Their identity, their main asset.
Totally. Built from the ground up.
Exactly. And because of that attachment, they might have, let's say, unrealistic expectations about its value. Also, there are typically fewer equity holders, which simplifies some things, but it can also concentrate the negotiation challenges and the due diligence headaches onto fewer people, often just the owner. Contract that with big deals where you have sophisticated repeat players, dedicated M&A teams, well-oiled processes.
Right, they've done this before, it's business.
Exactly. Here, you're often dealing with someone who has never sold a business before. They might not even know what questions to ask, what documents you need. It adds a whole layer.
So it's not just a financial transaction, it becomes a deeply personal one for the seller. That adds a whole layer of emotional complexity, I imagine.
Absolutely. Which leads right into the next point, organizational maturity, or often the lack thereof. Smaller businesses frequently lack those sophisticated internal structures, the formal processes, the dedicated legal and financial teams that bigger companies just take for granted.
Right, no big accounting department or in-house legal counsel usually.
Precisely. And this absence, this lack of formal structure, often leads to what the material we looked at vividly calls weird and wonderful complicated situations, things that require considerable effort just to untangle. Imagine trying to piece together a company's financial history from, like, informal spreadsheets, maybe some handwritten notes, and just the owner's personal memories.
Oh, wow. Versus a company with audited statements and data rooms.
Exactly. It turns due diligence, which we'll definitely dive into more into this painstaking forensic investigation. It's like trying to untangle a huge ball of yarn that a kitten's been playing with for a week.
That analogy really paints a picture. Okay.
But that fundamental difference is the paradox.
Yeah.
Small scale, but disproportionately human, informal, and therefore often deeply, deeply complex to unravel.
So it's not just the deal size, but the internal state or lack of formal state of the business being acquired that adds these layers of difficulty.
Exactly. And the financial structuring for these smaller deals also reflects this added complexity, this buyer uncertainty. For instance, the material points out that deals under $25 million frequently use earnouts. And these earnouts, as a percentage of the upfront payment, can be proportionally twice as large as in bigger deals.
Trade in your boring job for a brilliant career using Adobe Creative Cloud. Start learning now with the free trial link in the description.
Earnout. Remind me quickly what that is.
Sure, an earnout is where a part of the purchase price isn't paid at closing. It's contingent. It depends on the business hitting certain performance targets after the acquisition. So let's say, John, you were buying a small software company. The seller really believes they can sign up 50 new clients next year.
Okay.
Instead of paying 100% of the agreed value today, you might pay, say, 80% up front. And you promise the remaining 20% only if they actually hit that 50 new client target within, say, the next 12 months.
Ah, I see. It aligns incentives, makes the seller invested in proving the future potential. But that's a significant chunk of the deal still hanging out there for the seller.
It absolutely is. And there's more. Almost all deals in this lower middle market include at least one escrow, and over half have two or more.
Escrow, like when you buy a house. Holding money aside.
Similar concept, yes. An escrow is where a portion of the purchase price is held back. It sits with a neutral third party like a lawyer or a bank for a set period after closing. This money is set aside to cover potential future problems or liabilities. Things the seller promised were true, but maybe weren't, like a security deposit for the deal itself.
Okay.
Now, the material notes that the median general indemnification escrow for these deals is 12.5% of the transaction value.
12.5%. That's way higher than the usual 10% you hear about in bigger deals.
It is significantly higher. So for a $5 million business that John might be considering selling or buying, that could be $625,000 just sitting there in an escrow account, not in anyone's bank account, for maybe a year, maybe even longer.
What? That's not just a number. That's a huge portion of the seller's potential payout held back. It dramatically impacts their financial planning after the sale, their risk profile. It means a larger percentage of the seller's value is genuinely at risk, requiring much more creative, detailed deal structuring to handle the uncertainties that come with less transparent or, less mature target businesses. You might even see multiple escrows, one for general issues, another for a specific potential problem like an unresolved tax claim or a product warranty issue.
That adds a massive amount of uncertainty to a seller's finances post-sale. And I guess what might seem like a minor issue in a huge deal could be totally catastrophic for a smaller business, proportionally speaking.
Precisely. The whole concept of materiality is just vastly different. What might be a rounding error in a billion-dollar deal, a few missing documents, a small vendor dispute, maybe an outdated software license, could genuinely be a deal breaker for a lower value one, because its proportional impact on that smaller entity is just so much greater. Combine that with less formal record keeping, heavy reliance on the owner's personal knowledge, it really does turn due diligence into that forensic investigation, not just a standard review. Every loose thread is magnified, potentially critical.
So what does this all mean for you, whether you're looking to acquire or maybe thinking about selling your 4-year-old business like John from San Jose? It really sounds like you absolutely positively need the right guides to navigate this labyrinth of potential complications.
You've hit the nail squarely on the head. It becomes absolutely critical, non-negotiable, really, for both buyers and sellers in this market segment to engage experienced M&A advisors. You need professionals who live and breathe these kinds of deals.
Why specifically advise?
Because they are essential for navigating these unique complexities we've just talked about, for managing the inherent risks that pop up from less formal structures, disorganized data, and ultimately for ensuring a successful outcome, regardless of the deal's dollar value. Their expertise in untangling those weird and wonderful situations, advising on creative financial structures like those larger earnouts or multiple escrows, and critically, understanding the often intense personal dynamics at play, that expertise can truly make or break a deal in this space. It's not an expense, it's an investment in mitigating future disasters and maximizing the actual value you get.
Okay, now that we've really peeled back the layers on M&A for small businesses, understanding its unique complexities, let's dive into the why. What are the strategic imperatives? Why would an entrepreneur like John even embark on such an involved journey? What are the core motivations driving these deals?
Right. Well, the motivations are pretty diverse, but they generally boil down to a few key themes: fostering growth, boosting competitiveness, and securing that long-term viability. One of the most obvious and probably most common reasons is simply accelerated growth and market expansion.
Bigger, faster.
Exactly. For a small business, M&A offers this incredibly rapid path to scale up operations. You can often double, maybe even triple your size or your market reach far, far quicker than you ever could through organic expansion alone. It gives you immediate access to new markets, new customer bases, new distribution channels, significantly boosting your reach and development trajectory without those years of struggle and heavy capital spending that organic growth demands.
Like that local bakery example you mentioned, buying the competitor across town instantly doubles their footprint.
Precisely. It's about going from, say, 0 to 60 in market presence almost overnight, bypassing years of that slow, steady grind.
Okay, what else?
Beyond just getting bigger, M&A can be a really strategic move towards market dominance, or at least strengthening your position. Think about horizontal mergers. That's when two businesses in the same market combine.
Competitors joining forces.
Right. Often the goal there is to reduce competition directly and strengthen the acquiring company's overall market position. This kind of strategic consolidation can lead to higher market share, maybe more influence over pricing. For smaller businesses, this isn't just about size. It's about strategically positioning yourself to gain significant leverage within your existing market, or maybe dominate a specific niche. It makes it much harder for new competitors to come in.
So building a moat around your business?
In a way, yes, even if it's a local market. Acquiring your main competitor could make you the undisputed leader in your service area, for example.
Now, what about this idea of synergy? That's a word you hear constantly in M&A talk. Does it apply just as much to these smaller deals?
Synergy. Yes, absolutely. It's the primary goal for most M&A deals, big or small. The core idea is that the combined company's value becomes greater than just the sum of its individual parts. 1 + 1 = 3.
Okay. How does that actually happen?
Well, these synergies usually come in two main flavors: cost synergies and revenue synergies. Cost synergies are generally easier to see and quantify, and they're often a big driver for smaller deals. They come from economies of scale.
Right.
Like optimizing supply chains, buying materials in larger volumes gets you better prices, streamlining workforces, maybe you don't need 2 accounting departments or 2 receptionists,
Yeah.
integrating IT systems onto a single platform, consolidating facilities, maybe you only need 1 office instead of 2, reducing rent and overhead, direct, measurable savings.
So literally cutting out duplicate costs, making the combined operation leaner and more efficient than the two were separately.
Exactly. Then you have revenue synergies. These come from increasing revenue because of the combined operations. How? Well, maybe through cross-selling products or services to each other's customer bases. Imagine that digital marketing agency we talked about now offering web design services to the clients it just acquired.
Right. More services to the same, now larger customer pool.
Or you might increase overall market share, which gives you more clout. Or maybe you can even command higher prices because you now offer a more complete solution. Or you simply face less direct competition. Product extension mergers, where you combine companies selling different but related products in the same market, aim for exactly this, offering a wider range of products, expanding the customer base efficiently.
Okay, that sounds great, but I imagine it's not always easy to achieve those synergies, especially the revenue ones.
You're absolutely right to be cautious there. A realistic assessment of synergy potential is crucial, especially for smaller businesses. There's a very real risk of overestimating those projected financial results, those hoped-for synergies. For small businesses, the scale of potential cost savings might be limited compared to giant corporations. And revenue synergies, while they sound appealing, they are heavily dependent on successful integration after the deal closes. Effective cross-selling, that can be really challenging, often takes much longer than people expect.
So you need a solid plan for making it happen.
Absolutely. The upfront cost of the acquisition versus the expected return from these synergies needs meticulous consideration. You need to stress test those numbers against different scenarios. And the operational fit between the two businesses is critical. If the operations are misaligned, if the internal systems are incompatible, that can easily wipe out any potential gains. Hopes for synergy can quickly turn into integration nightmares.
It sounds like it's not just about getting bigger, but also maybe becoming more stable, spreading your bets, so to speak. Is that where diversification comes into play?
Precisely. That's another key motivator: diversification and risk mitigation. M&A can be a highly effective strategy for companies looking to diversify their product lines or enter entirely new markets. Why diversify? Well, it serves to stabilize your revenue. By spreading the business across different industries or different customer segments, you make the company less vulnerable to economic ups and downs or specific shocks hitting just one market.
So if one part of the business slows down, another might still be doing well.
Exactly. While you don't see many true conglomerate mergers companies from totally unrelated fields combining at the small business level, the principle of diversification is still vital. For small businesses, which often have very concentrated revenue streams, maybe relying heavily on one product, one service, or even one big customer, diversification through M&A can be a critical strategy.
It builds resilience against downturns, against industry-specific challenges. It moves beyond just growth. It's about building a more robust, sustainable, shock-resistant business model that can weather storms and secure that long-term viability. For John, if his business heavily relies on, say, residential clients, acquiring a similar business focused on commercial clients could really buffer him against shifts in either market.
That's a powerful benefit for long-term health. What about acquiring specific skills or even key people? Is that acqui-hiring thing real for small businesses too?
Oh, it's absolutely real, and it's a huge one, especially in this segment. Acquiring new technologies and talent. M&A provides this direct path to getting access to new tech, maybe specialized equipment, proprietary processes, often without needing that long, expensive, risky internal development cycle.
Buying innovation instead of building it.
Right. And then there's that specialized form of acquisition known as acqui-hiring. This is where the deal specifically targets the skills, the expertise, the institutional knowledge locked up in the target company's staff, maybe even more than its products or revenue. It's recognized as one of the fastest ways to bring on board new, experienced talent, completely sidestepping that often painful process of recruiting, interviewing, training.
Finding good people is hard. This sounds like a shortcut.
It can be. And the importance of talent acquisition is massively amplified in smaller, owner-centric businesses. These companies frequently rely heavily on the specialized skills, the deep institutional knowledge, the critical client relationships held by just a few key individuals, often including the owner themselves.
Right. The whole business might revolve around one or two people.
Exactly. And if you lose those critical individuals after the acquisition, it can severely damage the acquired business's value, its ability to operate. Sometimes it can even cause it to collapse. So for deals under $15 million, this talent acquisition aspect goes way beyond just general workforce expansion. It becomes fundamental to the deal's valuation, its risk assessment. Securing that critical human capital directly translates to operational continuity and realizing the deal's intended value. Imagine John's business acquiring a competitor mainly for their star salesperson and that person's Rolodex. If that salesperson walks out the door a month later, a huge chunk of the deal's value just vanished.
So it's not just buying assets or customers, but sometimes you're fundamentally buying the brain trust and the relationships that make the business tick. That's a crucial distinction for a smaller company. It's absolutely crucial. Beyond that, you also have motivations around competitive advantage and financial strengthening. M&A can be a strategic move to just plain outpace your competitors, maybe by gaining access to unique resources or capabilities they don't have. A well-done deal can also significantly strengthen your company's balance sheet.
How?
Well, the combined entity might have improved credit ratings, potentially leading to lower borrowing costs because you have pooled resources, maybe reduced overhead. This financial fortification, this strengthening, enables future investments, provides a buffer against economic swings, enhances overall resilience. It goes beyond the immediate deal benefits to secure the company's long-term financial health and maybe open doors to better financing options down the road.
And finally, you mentioned taxes. Are there often tax benefits driving these deals? Yes. Tax benefits in strategic financial planning frequently play a significant role. Sometimes, a company might acquire another, specifically to use the target's substantial tax losses to offset its own taxable income, reducing the overall tax bill for the combined entity. That could be a very direct, powerful financial driver.
Okay.
Also, the legal structure of the deal, whether it's structured as an asset purchase versus a stock purchase, can have profound impacts on both the businesses and the individual owner's tax outcomes. For small, owner-centric businesses, the personal tax hit for the selling owner is often a paramount concern. They want to maximize their after-tax proceeds.
Right. It's often their biggest payday ever.
Exactly. And creative deal terms, like those earnouts we discussed, or installment sales where the price is paid over several years, can offer significant tax advantages by deferring the recognition of capital gains. Instead of paying tax on the whole lump sum in 1 year, you spread it out, potentially staying in lower tax brackets. A poor understanding of deal structure and its tax consequences is a really common pitfall. It can wipe out a huge chunk of the money the seller thought they were getting. So getting tax and legal experts involved early is crucial to optimize the deal structure for maximum tax efficiency. It directly impacts the seller's net proceeds and the buyer's long-term cost basis. It's a complex chess game, and a wrong move can be incredibly expensive.
Okay, so we've really dug into why an entrepreneur like John might consider M&A the potential for rapid growth, diversification, getting key talent, financial benefits. Now, let's shift to the how. How does this actually happen on the ground for these deals under $15 million? The material suggests the process, while having standard stages, has unique quirks for smaller deals that demand super careful attention.
That's exactly right. Where the rubber meets the road, the process itself needs careful handling. It typically begins, like any major strategic move should, with strategic planning and target identification. This first phase is all about developing a crystal clear strategy.
What does that mean in practice?
It means articulating the precise purpose of the transaction. Why are we doing this? What specific goal are we trying to achieve? Outlining how you plan to finance it. Defining what you want the combined business to look like after the acquisition of the operating model. For smaller businesses, which often have limited resources and maybe less M&A experience, having this well-defined, clear strategy is exceptionally critical.
Why so critical?
Because without it, the whole process can just spin out of control, become chaotic, drain precious time and money. The goal isn't just to buy any business, it's to find the right business.
Yeah.
The one that precisely aligns with specific, measurable objectives, whether that's breaking into a new geographic area, acquiring a particular technology, or taking out a specific competitor.
So it's like setting your GPS with a very specific destination before you even start the car. You wouldn't just drive around aimlessly hoping to bump into the right opportunity.
Exactly. That clarity guides everything else. After you have the strategy, you move to target identification. This involves a thorough search, evaluating potential companies. And it means understanding not just the main target, but all its parts. Any subsidiaries, related entities, key assets, understanding their industries, their locations. This detailed picture is crucial for guiding the next phase, due diligence, effectively, making sure you're seeing the whole iceberg, not just the tip.
Okay, strategy set, potential target identified. Then comes that universal, often thorny question in any deal. How much is it actually worth? How do you even start putting a price tag on a small business in an M&A context?
Right. Valuation. This is absolutely pivotal. It's often the major point of discussion, negotiation, friction. To value a target properly, you need comprehensive access. Information about its operations, its customer base, its financials, its products, everything. The buyer naturally wants the lowest price possible. The seller wants the highest. So the valuation process is key to finding that middle ground, that mutually agreeable price.
And it's probably trickier for smaller businesses.
It often is. Because, as we've discussed, financial records might be less formal, maybe incomplete, maybe mixed up with the owner's personal finances, and seller expectations. Well, they can often be quite unrealistic, driven by that emotional attachment. So for smaller deals, valuation becomes more than just a numerical exercise. It's a critical tool for setting realistic expectations on both sides, anchoring the negotiations in objective data as much as possible, identifying risks of overpayment. A robust, multifaceted valuation, using several methods ideally, is essential to establish a defensible price range, manage those expectations, and reduce the risk of buying something with hidden problems or simply paying too much. It's about building a shared understanding of value, not just fighting over a number.
So it's not just about the number, but about managing expectations, identifying risks, and really setting the foundation for the whole negotiation that follows. Makes sense.
Precisely. Once you have some initial valuation models, the acquiring firm can present an offer. That kicks off the negotiation and letter of intent, LOI, phase. The letter of intent, or LOI, is a really critical document here.
Why is the LOI so important?
Signing an exclusive LOI can significantly reduce the risk of the deal falling apart. It formalizes the intent to move forward, usually locks out other potential buyers for a set period while you do more digging. The LOI marks a substantial commitment. It typically outlines key terms, the proposed purchase price, the payment structure, maybe a timeline for due diligence. The buyer might also put down a small deposit, like 1% or 2%. To show they're serious.
Okay.
Now, for sellers, it's important to know that business performance can sometimes dip a bit after an LOI is signed. Their focus and their key employees' focus might shift from running the business day-to-day to dealing with the transaction itself.
Right. Gets distracting.
It can. And for smaller deals where sellers might have less M&A experience or harbor those, perhaps optimistic expectations, the LOI serves a dual purpose. It provides a structured framework for the heavy lifting of due diligence that follows, and it signals serious commitment from the buyer. That can be vital for keeping momentum going, keeping the seller engaged during what can be a pretty long and demanding process.
And after the LOI is signed, that's when you really start kicking the tires, looking under the hood, doing that forensic investigation phase you mentioned, due diligence, right?
Yes, exactly, due diligence. This is widely seen as the most time-consuming and absolutely most critical phase of any M&A deal. It involves this meticulous, comprehensive examination analyzing the target company from every angle, internal, external. The goal is to verify the target's stated value, yes, but more importantly, to identify any undisclosed liabilities, any hidden risks, any red flags before the buyer fully commits.
And for deals under $15 million, this is where it gets really intense.
This is where it often transforms into that forensic investigation rather than just a standard review. Why? Because of those less formal structures, the potential for disorganized or incomplete records, the heavy reliance on the owner's personal knowledge, all common in smaller businesses. It really is a deep, deep dive into every single aspect of the business, leaving no stone unturned.
Then, of course, assuming the digging doesn't uncover deal breakers, you have to figure out how to actually pay for it all.
Absolutely. Financing the deal is the next crucial step. It can involve a mix of things, traditional bank loans, maybe private equity money, sometimes using the buyer's own cash reserves. But importantly, for deals under $15 million, specific financing options like SBA 7A loans and seller financing are particularly prominent. Often, they're essential to even make the deal happen.
Why are those two so key for smaller deals?
They often serve as creative ways to structure the deal, optimize it, and bridge those valuation gaps. We talked about the difference between what the buyer thinks it's worth and what the seller wants. The choice of financing significantly impacts the buyer's liquidity after the deal, their available capital, and it also impacts the seller's net proceeds and their tax situation. Understanding the pros and cons of each option is key to building the right financial structure for your specific deal.
And finally, after all that work, the moment of truth, the closing.
The closing of the transaction. Yes, the formal culmination of everything. At this stage, that definitive, legally binding document, usually an asset purchase agreement or maybe a merger agreement, gets finalized and signed. All the conditions precedent to closing things that had to happen first, like securing the financing, getting certain regulatory approvals, they all have to be satisfied. Then, funds are transferred, ownership officially changes hands, boom, it's done.
Sounds straightforward, but I bet it depends on the earlier stages.
Absolutely. A smooth closing is a direct reflection of how thorough and effective the previous stages were, especially the due diligence and the negotiation. Any issues found during diligence or things left unresolved during negotiation, they will directly impact the final terms in that agreement. Or they could even cause the whole transaction to just fall apart right at the finish line. It's the moment when all those carefully arranged pieces finally, hopefully, lock into place.
But wait, the journey doesn't actually end there, does it? You've bought the business, signed the papers, popped the champagne maybe, but you still have to make it all work together. You have to actually realize that value you hoped for.
That is absolutely right, and it's such a critical point, often underestimated. The period immediately after the closing, the post-acquisition integration phase, is arguably the most paramount stage for actually realizing the transaction's intended value, for ensuring sustained growth, for making the whole thing worthwhile. This isn't just administrative paperwork. It is a strategic imperative, especially for smaller businesses where that human element, those established relationships, the operational quirks, they're absolutely critical to success. This stage directly determines whether the strategic goals of the acquisition, the very reasons you went through all this complexity, are actually met and turn into tangible value. So many deals look great on paper, but completely falter at this integration stage if it's not handled with real precision and foresight.
We talked about valuation being pivotal, the cornerstone really, but how do you actually put that price tag on a small business, John? It seems like it can be so subjective. The material lays out several different methods, each suited for different types of businesses. Can you walk us through the most common ones that would likely apply to John's kind of business, or maybe a business he might be looking to acquire?
Excellent question. Because getting the valuation right, or at least establishing a credible range, guides everything: the negotiation, the financing, managing expectations. And for businesses under $15 million, the choice of valuation method is particularly critical because, as we've said, their financial structures, their operating characteristics are often quite different from bigger companies. Now, one method that's crucial, highly applicable, especially for owner-operated businesses or those where the owner is heavily involved day-to-day, is seller's discretionary earnings, or SDE.
SDE, okay, what's that involve?
It starts with a common metric, EBITDA, that's earnings before interest, taxes, depreciation, and amortization. But then SDE goes a step further. It adds back the owner's salary, any personal benefits the owner took through the business, like maybe a car lease, health insurance if it's above market, and importantly, any non-essential or purely one-time expenses that might have been run through the books.
Ah, those questionable add backs you mentioned earlier. Things a new owner wouldn't necessarily have as expenses.
Exactly. They might be perfectly legitimate for the current owner, but they're discretionary from a buyer's perspective. They wouldn't continue. This whole process, adding back these items, it provides a clearer, more normalized picture of the business's true profitability from the viewpoint of a prospective new owner.
Hmm.
For instance, if the owner paid their spouse a salary for minimal work or used the company card for personal vacations, SDE strips those out to show what the business itself really generates operationally.
So it's like peeling back the layers of the owner's personal financial life that got mixed in to see the core operating profit underneath.
That's a great way to put it. Once you have that calculated SDE number, you typically multiply it by an industry-specific multiple. This multiple usually ranges somewhere between 1 and 4, maybe a bit higher in some hot industries or for very stable businesses. It depends on market conditions, the stability of the cash flow, the industry itself, the perceived risk. This makes SDE often the most relevant and frequently the preferred starting point for valuation in these sub-$15 million deals. It gives that normalized, buyer-centric view of the small business's real earning power. It's very often the anchor for negotiations in this market.
Okay, SDE is key for owner-operated. What else?
Then you have broader income-based approaches. These focus on future earnings or cash flows. The discounted cash flow, or DCF method, is probably the most well-known and theoretically the most robust.
DCF, that sounds complex.
It can be. It involves projecting the company's future free cash flows out over several years, maybe 5 or 10 years, and then discounting those future cash flows back to their present value. You use a discount rate that reflects the riskiness of those cash flows and the time value of money. It's highly analytical, tries to capture the long-term intrinsic value. However,
There's always a however.
right, it's generally much better suited for larger, more mature companies that have stable, predictable earnings and really reliable, detailed financial forecasts. For many businesses under $15 million, especially those with less formal accounting, maybe highly variable performance year to year, or that heavy reliance on the owner's personal efforts accurately projecting those future cash flows needed for a precise DCF. It can be incredibly challenging, often quite speculative.
So for a small business that maybe doesn't have decades of perfect predictable earnings history, DCF becomes a bit like gazing into a crystal ball, heavily dependent on assumptions about the future that might be hard to make reliably.
Precisely. It's excellent in theory, but its practical application can be limited in the, let's say, weird and wonderful world of smaller M&A, where future visibility isn't always clear. It requires numerous assumptions, future growth rates, future expenses, market conditions, and the result is very sensitive to the discount rate you choose, which itself can be subjective. Another, simpler income-based approach is the earnings multiplier, which just applies a multiplier to the company's historical or maybe projected earnings, focusing on profits rather than just sales revenue.
Okay. What about looking at what similar businesses have sold for? Market comparisons.
Yes, those are market-based approaches. These value a company by comparing it to similar businesses that have recently been sold, or maybe even comparable companies that are publicly traded, though that's less common for small private businesses.
Mm-hmm.
The most direct is the multiples method. The idea is simple. Similar companies in similar industries should sell for similar prices, usually expressed as a multiple of revenue or EBITDA or FDE.
So if 3 local plumbing companies sold for 3 times their SDE recently, that gives you a benchmark for the 4th one.
Exactly. It's most effective when you have good, recent, relevant sales data from truly comparable private companies readily available. There's also the guideline public company, GPC method, using multiples from publicly traded companies. But honestly, this is generally less applicable for small private businesses. The differences in scale, market access, risk profile, growth potential, they're usually just too vast. And the guideline transaction method, which is similar to the multiples method but specifically looks at recent M&A transactions involving similar companies, making adjustments for specific differences between the target and the comps.
That sounds like a really good way to get a real-world check, grounding the valuation in what the market is actually paying right now.
It is, and it's a very strong component of valuing small businesses, often used right alongside SDE. But another but for small businesses, there's often a significant challenge here: the scarcity of truly comparable private company transaction data, especially if the business is in a niche market or has a really unique business model. Finding those perfect apples-to-apples recent sales can be difficult. Every small business has its quirks.
So comparable might be a pretty loose term sometimes.
It often is. It usually requires careful adjustments, maybe blending data from slightly different types of companies or combining it with other methods like SDE to get an accurate picture. A direct, perfect comparison is pretty rare in this space.
Okay, last category, asset-based.
Right, asset-based approaches. These value a company based on the value of its net assets, primarily tangible assets like equipment, inventory, real estate. These methods are most useful for maybe very early-stage companies or businesses that are losing money, or perhaps businesses where the physical assets are the main value driver. Think maybe a manufacturing plant, a trucking company, or a property management firm.
What kind of methods fall under this?
There's book value, which is simply total assets minus total liabilities right off the balance sheet, usually based on historical cost, so it often doesn't reflect current market value. Then there's net asset value, NAV, which tries to adjust those assets and liabilities to their current market values. Liquidation value is the estimated net cash you'd get if you had to sell off all the assets quickly, usually in a distress scenario, so it's often a floor value. And cost to replace, or reproduction cost, which estimates what it would cost today to acquire or build a similar substitute business with comparable functionality.
Okay, so to try and simplify this maze of methods, let's use the table from the material we reviewed to do a quick compare and contrast of these key approaches for you, John.
Good idea. Let's summarize the pros and cons.
All right. For sellers' discretionary earnings, SDE, the best use case is clearly owner-operated businesses, service companies, anywhere the owner's personal finances might be mixed in. The big pro. It gives that clear, normalized picture of true profitability from a buyer's viewpoint, adjusting for the owner's stuff. Plus, it's often much simpler to calculate than, say, a full DCF for many small businesses, making it very practical.
Right, but the con is, it might not be ideal for larger, more complex small businesses that maybe have professional management already in place. And its accuracy really hinges on correctly identifying and agreeing on those discretionary add-backs. What one person sees as discretionary, the other might argue is essential, right? That could be a negotiation point itself.
Good point. Then the discounted cash flow, DCF method. Theoretically best for businesses with stable, predictable earnings, reliable forecasts, maybe more mature small businesses. Its strength is that it focuses on long-term value creation, properly accounts for time and risk. Very comprehensive in theory.
But the huge challenge for DCF, especially with smaller businesses, is getting those accurate future cash flow projections. Very tough if records are informal, performance is variable, or the owner is the main driver. Plus, it's super sensitive to the discount rate you pick, which involves judgment. Garbage in, garbage out, potentially.
Okay. Moving to the multiples method, comparing to similar sold businesses. Ideal if you're in a well-established industry where there's actually accessible recent sales data from truly comparable companies. The clear pro. It gives you that real-time benchmark based on actual market deals reflecting current sentiment. Relatively straightforward if you can find good comps.
And that's the big con. The difficulty in finding truly comparable private companies, especially in niche markets or for unique business models, makes precise comparisons really hard. Plus, market conditions change fast, so last year's multiples might not apply today.
And finally, asset-based approaches. Best for maybe startups, businesses heavy on tangible assets like manufacturing, or maybe companies not making much profit yet, or even distressed situations. The big pro provides a clear, verifiable baseline value based on those physical assets. Useful for liquidation scenarios, too.
But the crucial insight, the big con for most profitable small businesses, is that it often massively underestimates the true value. It largely ignores intangible assets, things like earning power, customer relationships, brand reputation, goodwill, and those intangibles are often the most valuable parts of a thriving small business. Buyers are usually buying future potential, not just used equipment. Also, overvalued inventory or assets are common red flags that good due diligence needs to catch.
Now that we've got a better handle on how to actually value a small business, John, the next huge question is obvious. How do you pay for it? It's one thing to agree on a price, quite another to actually come up with the cash or financing. The material highlights some specific financing strategies that are absolutely pivotal for these deals under $15 million, often quite different from how giant corporations fund their acquisitions.
That's a critical point, absolutely. Securing the right financing is pivotal. It can absolutely make or break a deal. And for deals in this sub-$15 million range, the strategies often look quite different from larger corporate M&A. Buyers here frequently rely heavily on specific tools like SBA 7A loans and seller financing. These can be instrumental in making deals happen that just wouldn't be possible using only traditional bank lending criteria.
SBA loans and seller financing, those seem to come up again and again for small business deals.
They do, because they often serve as these creative structuring mechanisms. Ways to optimize the transaction, bridge those valuation gaps we talked about. They make ownership accessible to more people. Let's start with SBA 7A loans. These are very common, very attractive options for business acquisitions, and the maximum loan amount currently is $5 million.
$5 million is pretty substantial for this market.
It covers a lot of deals, yes. A key advantage is that these loans are partially guaranteed by the U.S. Small Business Administration, the SBA. That guarantee significantly reduces the risk for the bank making the loan.
Ah, so the government backing makes the banks more willing to lend.
Exactly. That government guarantee allows participating banks to offer more competitive terms than they might on a conventional business loan. Things like larger loan amounts relative to collateral, much longer repayment periods, and lower, often capped interest rates. This makes funding accessible even to business owners who might not meet the stricter requirements for traditional financing, maybe due to lower personal collateral or a shorter operating history for their existing business if they're buying another one.
So it really opens the door for more potential buyers, reducing the bank's risk threshold and letting more entrepreneurs step up to acquire a business.
Precisely. The benefits are significant. You get typically larger loan amounts compared to conventional small business loans. Much longer repayment terms, we're talking up to 10 years for working capital or equipment, and potentially up to 25 years for real estate or a full business acquisition. That longer term dramatically lowers the monthly payments, making cash flow management easier.
25 years is like a mortgage.
It can be, yes. And the interest rates are generally lower and capped compared to other small business lending options. Another huge advantage for buyers. You can often roll closing costs, sometimes even initial working capital needs, and maybe some funds for post-acquisition improvements right into the loan proceeds.
Oh, that's big, so you don't have to drain all your cash just to close the deal.
Exactly. It helps buyers preserve liquidity. That's critical for small business buyers who often have limited cash reserves. It lets them allocate their capital to integrating the business, handling unexpected expenses, funding future growth, rather than tying up every last penny in the purchase price itself. SBA loans are also particularly well suited for buying businesses where a lot of the value is intangible, like a strong client base, intellectual property, a skilled workforce, things that don't show up as hard collateral banks usually want.
That sounds incredibly flexible and a really powerful tool for aspiring business buyers. What are the main requirements or maybe potential catches that someone like John needs to be aware of if he's considering an SBA loan?
Right, it's not automatic. There are specific requirements and considerations. Borrowers typically need to inject some of their own cash, a minimum down payment, usually somewhere between 5% and 10% of the total acquisition cost, though some lenders or certain industries might require a bit more.
So you still need some skin in the game.
Absolutely.
Yeah.
And a personal guarantee of repayment from the borrower is required for nearly all SBA loans. That means your personal assets, your house, your savings are potentially on the line if the business fails and can't repay the loan.
That's a serious commitment.
It is. Also, the approval process. It can be quite extensive. More paperwork, more scrutiny than a conventional loan. It can be slower, sometimes taking up to 3 months, maybe even longer, because there's this layered review process involving both the bank and the SBA. So if you're working on a deal with a really tight deadline, an SBA loan might not be the fastest option. You need patience, and you need thorough documentation.
Okay, so SBA loans are a major pillar. What about the other one you mentioned, seller financing? How does that work?
Seller financing. This is another incredibly flexible and very common tool, especially for bridging those valuation gaps and getting deals done for smaller businesses. Simply put, this is where the seller lends a portion of the purchase price directly to the buyer.
The seller acts like a bank for part of the deal.
Essentially, yes. For example, say a business is selling for $1 million. The buyer might come up with $700,000 through cash, or maybe an SBA loan. The seller might then agree to loan the remaining $300,000 to the buyer, who then pays the seller back with interest over an agreed-upon period, maybe 3 to 5 years.
Wow, so the seller is literally financing the sale of their own business. That seems like quite a leap of faith for the seller, no?
It can be, yes. But there are significant benefits for sellers, too. Offering financing can dramatically broaden the pool of potential buyers. It includes people who are qualified and capable, but maybe couldn't get 100% financing from a traditional bank. More interest often leads to more competitive offers, potentially a higher final sale price.
Makes sense. More buyers competing drives up the price.
Right. Sellers also benefit from getting ongoing income through the interest payments on that loan. It creates a steady revenue stream after they've sold the business, which can be great for supplementing retirement or other plans. Plus, as we touched on with taxes, it can offer significant tax advantages. By receiving the proceeds in installments over time, they defer recognizing all the capital gains in 1 year, potentially lowering their overall tax burden. And deals with seller financing can often close faster because you're reducing the reliance on external bank lenders and their sometimes lengthy approval processes.
Okay, sounds good for sellers. What about for the buyers, like John? What are the advantages for him?
For buyers, it's often a much easier path to ownership. It typically requires less upfront capital because the seller is covering part of the price. Typical down payments in seller finance deals might be in the 10% to 30% range, often more flexible than bank requirements. And the terms of that seller loan are highly negotiable. Repayment schedules, interest rates, whether there's a balloon payment at the end. It's all up for discussion between buyer and seller. This allows buyers to really customize the financing to fit their specific financial situation, their projected cash flows. And just like with SBA loans helping preserve liquidity, seller financing does the same, maybe even more so. It preserves those precious cash reserves post-acquisition, which are vital for integration costs, working capital, handling surprises.
That sounds almost like a win-win situation, but I'm guessing there have to be risks or drawbacks for both sides in a seller financing deal. What are they?
You're right, there are always trade-offs. For sellers, the absolute primary risk is buyer default. What if the buyer stops making payments? That disrupts the seller's financial plans, and their recourse might involve trying to repossess the business, which is messy, costly, and something nobody wants.
Right. Getting the business back might not be easy or desirable.
Exactly. For buyers, seller financing usually comes with higher interest rates than traditional bank loans or SBA loans. This reflects the increased risk the seller is taking on by lending directly. And the repayment terms are often much shorter, typically in the 3 to 7 year range compared to maybe 10 or 25 years with an SBA loan. This puts more pressure on the business's immediate cash flow to make those larger payments. Buyers might also find they end up paying more overall for the business, maybe through a slightly inflated price the seller negotiated in exchange for offering financing, or just due to the higher interest rate. So meticulous negotiation of those terms is absolutely crucial for the buyer.
Okay. But you also mentioned seller financing isn't just about the money, right? It has a strategic element too.
Yes, and this is a really crucial insight, especially in smaller deals. Seller financing isn't just a funding mechanism, it's a sophisticated tool for risk mitigation and incentive alignment. Think about it. When the seller retains a financial stake in the business's future performance, because their loan repayment depends on it.
They have a vested interest in the buyer succeeding.
Exactly. The seller is highly incentivized to ensure a smooth transition, to help the buyer succeed, maybe even provide some guidance or support during that initial period, because their repayment directly depends on the business continuing to perform well under the new owner. This mechanism effectively shares the risk between the buyer and the seller. This is particularly valuable in smaller deals, where the buyer might have more uncertainty due to those less formal records or the business's reliance on key individuals. The seller effectively becomes a silent, invested partner in the buyer's success, at least until the loan is repaid.
That's a fascinating angle. Okay, to make this crystal clear for John and everyone listening, let's quickly run through that direct comparison provided in our material between SBA 7A loans and seller financing. It really highlights the distinct features and trade-offs.
Okay, let's lay them out side by side.
All right, first, loan size. An SBA 7A loan, as you said, goes up to $5 million, pretty substantial. Seller financing, on the other hand, is typically a percentage of the sale price, maybe 10% to 60%, and it's highly negotiable based on the specific deal and what both parties are comfortable with.
Right. Then collateral. SBA 7A loans require the business assets to be pledged, and critically, that personal guarantee from the buyer, putting their personal wealth on the line. With seller financing, the seller usually takes a security interest in the business assets too, but the specifics, what assets, the priority of their claim, that's all highly negotiable between the buyer and seller.
Got it. What about the cash down payment required? SBA 7A loans typically need that 5–10% minimum cash injection from the buyer, maybe more depending on the lender's assessment. Seller financing usually involves maybe a 10–30% down payment, but again, this is much more flexible and negotiable. Sometimes it can be structured lower if the seller is motivated.
Exactly. Now, interest rates. SBA 7A loans generally offer lower, often fixed or predictably variable rates, usually tied to the prime rate plus a set margin. Very competitive. Seller financing rates. They're fully negotiable, but often higher than traditional bank loans because the seller is taking on that direct default risk.
Makes sense. Repayment terms are a big difference too. Significantly longer for SBA 7A loans, up to 10 years for working capital equipment, maybe 25 years for the business acquisition itself, really spreading out that burden. Seller financing terms, generally much shorter, often just 3 to 7 years, requiring quicker repayment and higher payments.
Yep. The approval process is another contrast. For an SBA 7A loan, it's rigorous. Expensive paperwork, layered review by the bank and the SBA can take up to 3 months easily. Seller financing. It's just direct negotiation between buyer and seller. Generally much quicker, could be days or weeks once terms are hammered out.
Flexibility. Sounds like SBA 7A loans are pretty standardized, with structures and rules set by the SBA. Seller financing, though, offers highly adaptable terms based entirely on that direct buyer-seller agreement. Lots of room for creative solutions.
Absolutely. And that ties into risk distribution. With an SBA 7A loan, the lender assumes the primary risk, but it's backed by the SBA guarantee, and the buyer provides collateral and that personal guarantee. For seller financing, the seller assumes the direct risk of the buyer defaulting. That's why they're so invested in the buyer's success.
And finally, fees. SBA 7A loans might have smaller upfront fees compared to some conventional loans, and closing costs can often be rolled in. Seller financing typically has minimal fees associated with it. You're cutting out a lot of the bank's administrative costs, making it potentially very cost-effective to structure the deal itself.
That's a good summary of the key trade-offs between those two main options.
Now, beyond these two pillars, SBA loans and seller financing, which clearly dominate the sub-$15 million M&A financing world, are there any other ways to finance these smaller deals that John should maybe be aware of, even if they're less common?
Yes, there are other avenues, though they might be less frequent or more specialized for this particular market segment. Buyers can, of course, always use their existing cash reserves, but that's obviously limited by how much cash they have on hand, and it often isn't enough to fund the entire acquisition, nor is it always wise to drain all your cash.
Right, you need working capital after the deal closes.
Exactly. Beyond that, you sometimes see private debt funds or small business investment companies, SBACs. Those are privately owned investment funds licensed by the SBA or business development companies, BDCs. These are essentially non-bank lenders. They often provide more flexible structures, maybe covenant-light agreements.
Covenant-light, meaning fewer restrictive rules.
Fewer restrictive clauses, yes. Things that might limit the business's future actions, like how much additional debt it can take on, or whether it needs the lender's permission to sell certain assets. However, these alternative lenders typically come with higher interest rates than traditional bank or SBA loans, and they might require warrants, the right to buy equity later, or even demand an outright equity stake in the acquired business from the get-go, giving the lender a piece of the upside potential.
So more flexibility, but potentially at a higher cost or giving up some ownership.
That's the general trade-off, yes. These various financing options, cash, SBA loans, seller financing, private debt, they really represent a spectrum of flexibility versus cost, and also risk allocation. Generally, the more flexible the financing, the higher the cost might be, or the greater the risk assumed by one of the parties involved. Buyers and sellers have to evaluate all these options based on their specific risk tolerance, their liquidity needs, the urgency of getting the deal done, and their comfort level with potentially giving up equity. It's all about finding the right capital structure that fits the specific needs of the deal and the comfort level of everyone involved.
Okay, we've circled back to due diligence a few times now, even calling it a forensic investigation for these smaller deals. The material really hammers home that for small businesses, due diligence isn't just important. It is the most critical and often the most time-consuming phase of the entire M&A process. Why is it so absolutely crucial, and what exactly does it entail for a deal under $15 million, given all those unique challenges of smaller businesses we've discussed?
You're absolutely right to emphasize it. Due diligence is paramount, non-negotiable. It is the buyer's essential opportunity there, right, really to thoroughly examine every single aspect of the target company, to verify all the information the seller has provided, and critically, to proactively uncover any hidden problems, any undisclosed liabilities, any potential red flags before they commit hundreds of thousands or millions of dollars to the purchase. For small businesses where records might be less formal, maybe incomplete, maybe tangled up with the owner's personal life, due diligence truly does become that painstaking investigative process. You have to put on your detective hat.
So what are the key areas you're investigating? What does this detective work cover?
It breaks down into several key streams, all interconnected. First, there's financial due diligence. This is the deep dive into the company's financial health. You're reviewing at least 3 years, preferably 5, of financial statements, balance sheets, income statements, cash flow statements, plus monthly management reports, bank statements, all the tax returns filed, comprehensive lists, and documents for all debts and liabilities.
What are you looking for specifically?
You're assessing the actual cash flow, not just reported profit. Investigating the true nature of liabilities. Are they accurately recorded? Scrutinizing those tax filings. Are they complete? Accurate? Were they filed on time? Are there potential unpaid taxes lurking, like payroll taxes or sales taxes, that could become the buyer's problem immediately after closing? You're identifying any non-recurring revenue that might be artificially inflating profits, looking for accounting inconsistencies, basically finding out if the numbers the seller presented are real, verifiable, and sustainable, and if there are any financial skeletons hiding in the closet.
So really digging into every single penny, validating every number recorded, not just taking the seller's word for it.
Exactly. You have to. Then there's legal due diligence. This ensures the business is legally sound, properly structured, and free from hidden legal bombs. You're examining corporate formation documents, articles of incorporation, bylaws, operating agreements, any shareholder agreements. Critically, you review all significant contracts. Customer contracts, supplier agreements, key employee agreements, sales or distribution contracts.
What are you looking for in the contracts?
Are they assignable to the new owner? Do they contain unfavorable clauses like automatic renewal terms or change of control penalties? Are any key contracts about to expire? You also verify all necessary business licenses and permits are current and valid, ensure regulatory compliance in their industry, and crucially, identify any current or even threatened or pending lawsuits or legal disputes that could become a costly liability for the buyer. You need to make sure the business truly owns what it claims to own legally and isn't about to get blindsided by a major legal issue.
Okay, financials, legal. What's next?
Operational due diligence. This investigates the actual day-to-day workings of the business. How does it really function? You're analyzing the core business model, key operational processes, the competitive landscape it operates in, overall market trends. You might review production processes, distribution channels, supply chain management, marketing and sales strategies, pricing structures, standard operating procedures, if they exist. It provides a clear understanding of how the business makes money, where its efficiencies are, and where its operational vulnerabilities lie. For a small business, this might literally mean walking the shop floor, talking to frontline employees, if permitted, observing how orders get processed from start to finish.
Getting a feel for the real nuts and bolts. And what about things like patents or proprietary software, or even just the company's brand name? Is that covered?
Absolutely. That falls under intellectual property, IP due diligence. For many businesses today, even small ones, their IP represents significant, often unquantified value. Maybe it's a unique software platform, a secret recipe, a strong local brand name, customer lists. This involves creating comprehensive inventories of all patents, trademarks, copyrights, trade secrets, including any pending applications. You assess the enforceability of these IP rights. Does the company actually own them free and clear? Are they properly protected? And you identify any potential for IP-related litigation, maybe trademark infringement claims against them or by them. In our digital age, this can get incredibly complex, covering everything from website content and domain names to customer databases and software code.
Okay, makes sense. Anything else?
Yes, one more critical area, especially for smaller businesses: human capital due diligence. This focuses squarely on the people, often the most critical asset in these owner-centric companies. You're reviewing the employee structure, HR policies or lack thereof, payroll records, compensation plans, benefits packages. Crucially, you identify the key personnel. Who are the indispensable people? What are their roles? You assess the adequacy of the workforce, the general morale, and what talent retention strategies, if any, are in place. This is where you determine if the business is truly sustainable without the current owner or without one or two irreplaceable star employees.
And you said these are all interconnected.
Highly interconnected. For example, finding high customer concentration during operational DD, that's an operational risk, right? But it directly impacts the financial projections and the business's long-term stability. Similarly, discovering an over-reliance on the owner during human capital DD severely affects operational continuity and future financial performance. And disorganized, incomplete, or inconsistent records. That can impede effective review across all these areas, highlighting why you need cross-functional expertise on your advisory team and why it often feels like a forensic investigation. You're piecing together a puzzle from different boxes.
This sounds like a genuine minefield. I can almost picture John with a flashlight and a magnifying glass trying to unearth all these potential hidden issues. What are the most common pitfalls, the biggest red flags that buyers like John should be intensely aware of during this painstaking process?
It definitely can feel daunting. And successfully navigating it is precisely why having those experienced advisors is so critical. One major pitfall is overlooking financial red flags. Things like not properly identifying non-recurring revenue that might be artificially inflating the historical profitability, maybe a huge one-time project last year that won't repeat. Spotting accounting inconsistencies between different periods or reports. Not digging deep enough to uncover potential undisclosed tax liabilities, like those unpaid payroll or sales taxes we mentioned. Misjudging the actual working capital needed to run the business smoothly. Post-acquisition sellers might understate this, and in small businesses, those questionable add-backs and personal expenses run through the business. They need rigorous, almost forensic scrutiny because they can significantly distort the true underlying profitability.
So, not just accepting the surface numbers, really questioning everything.
You have to. Another huge risk is missing hidden liabilities. These are things that might not show up clearly on the main financial statements. Undisclosed liens on property or equipment. Maybe environmental violations from past operations on a piece of real estate, pending litigation that the seller hasn't formally disclosed yet, or what lawyers sometimes call toxic contracts agreements that could bind the new owner to really unfavorable terms or trigger massive unforeseen expenses down the road. Sometimes standard accounting review isn't enough. You might need actual forensic accounting techniques to uncover these off-balance sheet bombs waiting to explode after closing.
Things lurking just beneath the surface that could blow up later. Yikes.
Exactly. Then there's the trap of overestimating projected financial results. Sellers naturally can be overly optimistic about future growth. Sometimes projections might even be intentionally inflated. Financial forecasts that aren't backed by solid historical trends or realistic market analysis or conservative assumptions, they can lead a buyer to significantly overpay based on phantom future profits. It's essential to stress test those projections against various market conditions, different scenarios, and thoroughly evaluate risks like customer concentration. If 80% of the revenue comes from one single client, that projection is incredibly fragile.
Good point. What else?
Failing to adequately assess internal controls. Weak internal controls are common in small businesses, and they expose the company to risks of fraud, errors, and mismanagement. Things like a lack of segregation of duties. Maybe the same person handles cash receipts and does the bank reconciliations. Poor inventory tracking. Informal cash handling processes. These are just administrative issues. They can lead to operational inefficiencies and create opportunities for substantial financial losses. A really critical process red flag, which often signals underlying problems, is rushing the due diligence process. Hasty reviews may be driven by an artificial deadline, a desire to close quickly, or pressure from the seller. These can result in incredibly costly oversights. There's an old saying in M&A, everything that drags gets dirty, meaning if diligence takes too long, you'll inevitably find something minor to quibble over. But thoroughness is still paramount. The cost of taking an extra month to do diligent investigation properly is almost always minimal compared to the potential cost of acquiring the wrong company or buying a company with huge hidden liabilities. That extra time can literally save you a fortune.
That makes perfect sense. Being penny-wise and pound-foolish with diligence seems like a terrible idea, especially with a multi-million-dollar investment on the line.
Absolutely. Another significant operational red flag is that over-reliance on individuals we keep mentioning. If the business would seriously struggle, or maybe even fail entirely, without one key person, whether it's the owner, a top salesperson with all the relationships, a technician with unique process knowledge, a specific customer relationship manager, that's a massive risk concentration. It needs to be identified and addressed head-on, usually with robust retention plans or knowledge transfer strategies. Similarly, customer concentration. High dependence on just one or two customers for a large chunk of revenue makes the business extremely vulnerable if those clients leave or reduce spending after the acquisition. Diversification of the client base is always preferable, and perhaps the most telling red flag of all, seller resistance to transparency. An unwillingness to provide full access to requested documents in a timely manner, refusing reasonable requests for site visits or access to key employees, pressuring the buyer to make quick decisions before due diligence is substantially complete. These are all significant warning signs. The more a seller seems to resist transparency, the more critical and thorough your due diligence must become, because it strongly implies they might have something to hide. Buyers simply must adopt a highly skeptical, investigative mindset during this phase. The mantra has to be trust, but verify. Assume issues are likely present, and finding them is a critical part of mitigating risk and ensuring you're negotiating based on reality, not just the seller's story. It's not about being mistrustful. It's just smart business practice.
It sounds like you absolutely, positively cannot fly solo in this due diligence process. Trying to navigate this minefield alone seems like a guaranteed recipe for disaster.
You truly cannot. Flying solo through M&A due diligence is inherently incredibly risky because these transactions are just so complex. They have numerous financial, legal, operational, tax, human capital nuances, aspects that even very experienced business owners are unlikely to be experts in across all domains. Engaging a multidisciplinary team of experienced M&A advisors, people who do this for a living, it's not a luxury. It's an absolute necessity, especially for deals under $15 million. These professionals bridge that lack of expertise gap that almost always exists within a small business's internal team. They provide specialized knowledge that an owner, busy running their own business, simply cannot possess across all these critical areas.
So who should be on this dream team of advisors?
Typically, you'll need a qualified accountant, ideally one with specific M&A transaction experience. They analyze the financials for quality of earnings, ensuring the profits are real and sustainable, not just accounting tricks. They identify tax risks, assess the reasonableness of those add-backs, validate financial projections with an independent, critical eye. Then you absolutely need a business attorney, again, one experienced in M&A. They guide you through all the legal complexities, meticulously examine contracts for risks and assignability, ensure regulatory compliance, help structure the deal legally to mitigate future liabilities. And increasingly, depending on the business, you might need technical experts. Maybe IT professionals to assess digital security, evaluate the tech infrastructure, judge IT capabilities if it's a tech-heavy business. These advisors, working together, help identify and quantify the risks you find. They help structure the deal effectively, maybe suggesting specific protections like escrows or earnouts based on what they uncover. And they help you negotiate more advantageous terms based on facts. Their fees, typically somewhere between 1% and 3% of the total transaction value, depending on complexity, should really be viewed as a critical investment in risk reduction and value optimization. They prevent you from making far more costly mistakes down the line. It's paying a relatively small amount to avoid a potentially catastrophic loss.
And focusing on the sellers again for a moment, especially in light of all this diligence, the material talks about those common deal structuring mechanisms like earnouts and escrows having huge implications for when and how sellers actually get their money. Can you elaborate on those implications from the seller's perspective?
They do have huge implications. And their prevalence, and often their larger percentage of the total transaction value in this sub-$50 million market segment, are direct indicators of that higher perceived risk and that potential trust deficit buyers often feel when looking at smaller, less formalized businesses. Buyers are actively looking for ways to mitigate the uncertainty that comes with less structured operations or less robust financial reporting. Let's look at earnouts again from the seller side. Remember, these are contingent payments based on the business's performance after the sale. They're useful for bridging valuation gaps, aligning incentives, managing buyer risk, all true. But for the seller, the material indicates that in this lower middle market, the earnout portion typically represents somewhere between 15% and 30% of total purchase price. And for the smallest deals, under $25 million, that earnout percentage relative to the cash paid at closing can be twice as large as you typically see in bigger transactions.
Twice as large. So a really significant chunk of the seller's total potential payout isn't guaranteed at closing. It depends entirely on future results achieved under the buyer's control.
Exactly. It's often tied to specific, measurable metrics, hitting certain revenue targets, achieving a certain level of EBITDA or net profit, maybe retaining key customers over a set period, usually 1 to 3 years. Now, while earnouts can offer potential upside for the seller if the business outperforms, and they do offer tax deferral benefits since the income is received later, they're also notorious for leading to disputes.
Why disputes?
If the performance metrics aren't crystal clear and unambiguous in the agreement, if the seller feels the buyer's actions after closing may be changing strategy, underinvesting, integrating poorly, are hindering the business's ability to achieve the earnout targets, or if the seller simply disagrees with how the buyer is calculating the results, a seller agreeing to an earnout absolutely must insist on incredibly clear definitions for those performance metrics, robust audit rights to verify the buyer's numbers, and ideally, requirements for the buyer to maintain separate books for the acquired business during the earnout period to ensure transparency and accountability. A well-drafted, very precise earnout agreement is crucial to minimize the potential for future litigation.
So sellers need to protect themselves contractually if a big chunk of their money is tied to an earnout. What about escrows? How do they impact the seller?
Escrows, too, have a major impact. Remember, this is a portion of the purchase price held back in a neutral account for a set period, usually 12 to 18 months, to cover potential claims by the buyer after closing. Maybe for breaches of representations and warranties the seller made in the purchase agreement, or for specific identified risks. Virtually all deals in this lower middle market include at least one escrow, and as we noted, over half feature two or more, maybe one general escrow and one for specific issues like taxes or environmental concerns. The material highlights that the median size of the general indemnification escrow for these LMM deals is 12.5% of the transaction value. Again, significantly higher than the 10% median often seen across all deal sizes.
That really drives home the point. For John selling his hypothetical $5 million business, that 12.5% means $625,000 of his money is locked up, inaccessible, for potentially a year and a half after he sells.
Exactly. It means a larger percentage of the seller's potential proceeds remains at risk, contingent on no claims arising. Buyers use these larger escrows as a security blanket, protection against the uncertainties and potential hidden liabilities they might suspect or have uncovered during diligence, especially when dealing with less formal records or operations. So sellers operating in this sub-$15 million market need to anticipate these mechanisms. They need to understand the implications for their net proceeds, their post-closing cash flow, their ongoing potential liability. And they absolutely must negotiate the terms of the escrow meticulously, the amount held back, the duration it's held for, the specific conditions for releasing the funds, the process for making claims, because this directly impacts their liquidity and final payout after the deal closes. It's a key part of that risk sharing inherent in smaller M&A deals.
Okay, so let's fast forward. Imagine John has successfully navigated this entire complex M&A process. He found the right business, survived the forensic due diligence, secured the financing, negotiated the earnouts and escrows, and the deal has closed. Now what? The material strongly suggests that the period immediately following closing is arguably the most critical phase of all for actually realizing the intended value. That this integration isn't just administrative cleanup, it's a strategic imperative that can make or break the entire investment. What makes this post-acquisition phase so absolutely crucial, especially for smaller businesses?
You've hit on the absolute core truth. The integration phase is precisely where the value promised by the deal is either captured and amplified or, sadly, often destroyed. Successful post-acquisition integration is paramount. It's not an afterthought. It is the key to realizing the transaction's intended value and ensuring sustained growth and innovation. The foundational step, before anything else, is defining clear integration objectives.
What does that look like?
These objectives need to be crystal clear, measurable, achievable, and tightly, explicitly aligned with the initial strategic goals that drove the acquisition in the first place. Was the goal to expand service offerings, penetrate new geographic markets, achieve specific cost efficiencies, retain key technical talent? Whatever it was, those goals need to translate into concrete integration objectives.
So having a clear roadmap for what success looks like after the deal.
Exactly. It provides that roadmap for all the integration efforts and gives you a framework for actually measuring success later on. Without specific, measurable objectives, the integration process can easily become unfocused, chaotic, reactive, and incredibly resource-draining. This leads directly to that common pitfall of lack of planning and strategy failures in M&A. For small businesses, which always operate with limited resources, having that laser focus during integration is absolutely paramount. It ensures the acquired business genuinely contributes to the overall growth and value. It doesn't just become an expensive, time-consuming distraction. You need to plan the marriage just as carefully as you plan the wedding.
It really sounds like planning the post-acquisition strategy is almost as important, maybe even more important than getting the deal done itself, given how many deals apparently fail at this integration stage.
It truly is where the hard work often begins. And one of the most critical, yet frequently overlooked or underestimated aspects of integration is the critical role of cultural integration and talent retention. This human element is absolutely vital.
Culture. How does that play out in a small business acquisition?
Cultural integration is critical to long-term success. Think about it. You're bringing together two potentially very different groups of people. Differences in leadership styles, how we do things around here, employee expectations, communication norms, email versus meetings versus hallway chats, decision-making processes, top-down versus collaborative, even core underlying values. All these can cause significant friction between the merging entities if not managed carefully.
I can easily imagine clashes leading to problems.
They absolutely do. Cultural clashes can lead directly to confusion, plummeting employee morale, active resistance to change, communication breakdowns, and ultimately loss of key talent, often the very people you acquired the business for. Conversely, creating a unified, positive culture can significantly boost morale, improve retention, increase productivity, and unlock those hoped-for synergies.
And I bet this is even more sensitive in smaller businesses where the owner's personality often defines the culture. It's not just some corporate mission statement on the wall, it's how people interact every single day.
Exactly. For smaller, owner-centric businesses, that human capital, the key employees, the founder's deep institutional knowledge, the established company culture, often represents a huge, yet usually unquantified portion of the acquired value. If this human element is mishandled during integration, those financial synergies and strategic goals that look so good on paper may simply never materialize. That over-reliance on individuals' risk we discussed, it means the business could genuinely struggle or even fail without them if they leave due to cultural friction. When the acquired team feels like their work family has been invaded or disregarded, the challenges of opposing workplace cultures and employee resistance are massively magnified in these less formal small business environments, where personal relationships and deeply ingrained norms hold much greater sway than corporate policies might in a larger firm. You're dealing with people's livelihoods, their identities, their work relationships.
So how do you navigate that? What are the strategies?
It requires proactive effort. Assessing cultural differences early on, even informally through cultural audits, basically. Spending time talking to people from both sides, observing interactions, identifying those key unwritten rules and norms. Transparent, honest communication from day one is absolutely vital, involving leaders, formal or informal, from both organizations in the integration planning process. Taking the time to define new core values for the combined entity. Actively working to build trust through genuine engagement and open dialogue. And equally paramount alongside culture is talent retention. People are the key assets needed to realize the value. Losing key employees can severely undermine the deal's success, especially if they hold critical client relationships or possess unique, specialized knowledge.
So how do you keep the good people from leaving?
Strategies involve working closely with the seller before the acquisition closes to identify who the truly key employees are and understand what motivates them. Taking the time to understand employee concerns, post-announcement job security, potential role changes, new bosses. Transparently communicating the vision for the combined entity and their role in it. Offering appropriate rewards, that means fair compensation, clear opportunities for advancement, recognition for their contributions and experience. Sometimes, specific retention agreements, maybe offering bonuses for staying for a defined period like 1 or 2 years, can be very effective for critical individuals. Actively seeking employee buy-in for the new vision is key. Both monetary and non-monetary incentives, like challenging projects, learning opportunities, a positive work environment, are crucial for keeping critical talent engaged and committed during a period of uncertainty. For these sub-$15 million deals, culture and talent are not just HR issues. They are fundamental strategic imperatives directly tied to the acquisition's success and its return on investment. Without the right people staying on board and buying in, you often have nothing left but an empty shell or underperforming assets.
So it's not just about integrating the people and their culture, but also the practical stuff, the operations, the systems, especially if the acquired business had those messy or inconsistent records we talked about earlier. How does that get handled?
Absolutely. Operational and system integration is the nuts and bolts work crucial for achieving those anticipated efficiencies and enabling future scalability. This involves carefully evaluating and then integrating the technological assets and systems of both companies. Things like accounting software, CRM systems, digital marketing tools, operational platforms, databases. You need to get them talking to each other, or, more often, decide on a single platform for the combined entity and migrate the data. The goal is seamless operations and unified data flow.
Getting everyone onto the same page technologically.
Right. And harmonizing operational processes, standardizing workflows where it makes sense, establishing a set of best practices across the newly formed organization that's also vital. For smaller businesses, which, as we've said, may have less sophisticated or maybe fragmented systems, potentially those messy or inconsistent records, this integration phase isn't just about combining what exists. It's often a necessary opportunity to upgrade, to professionalize, to formalize processes that were previously perhaps informal, ad hoc, or just inefficient. This streamlining itself can lead to significant increases in operational efficiency, immediate cost reductions, and it allows the combined business to truly scale in a way that maybe neither could achieve individually. It's about building a much better, more robust engine for the combined vehicle.
And critically, through all this internal change and upheaval, you have to keep the external focus too, right? Keep your customers happy, ensure no disruptions to service, because that customer concentration issue can be a real vulnerability.
That is spot on. Client communication and service continuity are absolutely crucial during integration for safeguarding revenue and market position. Given that customer concentration can be a major red flag found in due diligence, and that customer satisfaction is often closely tied to the existing company culture and service delivery standards. Losing key clients during the integration turmoil can directly undermine the very revenue streams that probably motivated the deal in the first place.
So how do you prevent clients from fleeing?
Proactive, clear, and transparent communication with clients about the acquisition is essential. You need to explain what's happening, why it's happening, and importantly, highlight the benefits for them. Maybe enhanced services, more resources, greater stability. Reassuring them about continuity is key. Ensuring there are absolutely no service disruptions and maintaining or even improving delivery standards throughout the transition period are paramount to keeping clients calm, reassured, and retaining their loyalty. This might involve joint outreach from both the acquiring owner and the selling owner, if they're staying involved, emphasizing stability and a commitment to their ongoing success.
Makes sense. Keep the external stakeholders informed and happy. So what's the final piece of the integration puzzle?
The final piece is really about actively leveraging synergies and standardizing best practices. This is the phase where you transition from planning integration to actively pursuing and realizing those anticipated synergies that justified the deal price.
Making the 1 + 1 = 3 actually happen.
Exactly. This involves diligently identifying and executing on opportunities for cross-selling and upselling services or products across the combined client base to generate that new incremental revenue. It's about systematically standardizing workflows, project management methodologies, client engagement processes across the newly formed organization to enhance efficiency, reduce costs, and ensure a uniform quality of service or product delivery, adopting the best of both worlds. Investing in comprehensive training and development for the combined workforce is also critical here, equipping everyone with the new skills, knowledge, and understanding of the new processes and goals. It's important to remember that successful integration isn't a one-time event with a finish line. It's really an ongoing dynamic process focused on actively extracting the anticipated value from the combined entities. It requires proactive management, continuous investment of time and resources, and often a dedicated integration team or leader, even if it's just one or two people focusing on it part-time in a small organization.
So as we bring this really deep dive to a close, it seems abundantly clear that mergers and acquisitions, even operating under that $15 million threshold, are undeniably powerful strategic tools, especially for small businesses like John's out there seeking that accelerated growth and a real competitive advantage in today's dynamic markets.
Absolutely.
Thanks for joining us for this deep dive.
It's been a pleasure.
We'll see you next time.
See you later.
Okay, great. That's a wrap. I'm Katie St. Ors, and let me send out a huge thank you for listening. If you want more content on personal finance and small business, head over and find me on YouTube. You can also find me on Spotify, Amazon Music, TikTok, and Apple iTunes. Thanks again for tuning in, and I'll catch you on the next Deep Dive podcast.